Good morning, Liba.
Good morning.
Okay, let's see. Let's get going right away here. We got a big chapter 4 to go, huh? So let me share the screen. Okay. All right. Chapter 4, we're going to get into adjusting journal entries, kind of a tricky area, okay? Let's talk about the accrual basis of accounting and the reasons for adjusting journal entries. We work with what's called an accrual basis of accounting, everybody. Accrual. What that means is revenues and expenses are recorded at the moment they are incurred, okay? They have nothing at all to do with when the payment is made. In other words, you sold something on August 1st, but you don't get paid until September. That revenue gets recorded in August because that's when the activity took place, okay? And what they're starting off with is a word you've never used in a conversation, nor have I, periodicity. Periodicity. It simply means that a business activities can be broken down into a finite time period, such as a month, a quarter, a year, okay? So we can report on the business for 1 month or whatever period we like. Accrual basis. What is the periodicity? The economic life can be divided into artificial time periods, okay? Revenue recognition. Revenue is recognized in the accounting period in which the service is performed, okay? The service is performed. Has nothing to do with the payment of the goods. Payment can come later. Payment can come in advance. It's when you actually perform the service that you recognize the revenue, okay? Now they're giving us a long-winded grid here, and we'll just look at this briefly. This is a little too much to bite at one time. But revenue recognition, identify the contract, identify the performance, determine the price, allocate the transfer price, recognize revenue. This screen here, I would tell you to skip. That's a bunch of jargon that's not going to help you at all, I don't believe. Accrual basis and revenue recognition. Companies recognize expenses in the period in which they make efforts to generate revenue. In other words, expenses are recorded when they are incurred, when they happen. Again, has nothing to do with the payment of the cash. So we have a couple of things here. We have that periodicity assumption, and that's part of GAAP. That's a GAAP term, generally accepted accounting principles. We have the revenue recognition principle, which we just went over. Revenues are recognized in the period in which the obligation is satisfied, and expenses are recognized when you incur them, when they happen. In accordance, and this is all in accordance with GAAP, generally accepted accounting principles. You might hear somebody say that they have a company and they run it on a cash basis of accounting. We don't teach cash basis of accounting here. It's not GAAP. If you go on a cash basis of accounting, you're going to cash basis yourself out of business because you'll never be able to come up with decent financial statements. What is the accrual basis of accounting, or what is false about it? Well, let's look at what's true. Which of the following statements is false? A, events that change the company's financials are recorded in the periods when the events occur. That's true. Revenue is recognized in the period when the services are performed. True. This is in basis with generally accepted accounting principles. 4, revenue is recorded only when cash is received. That's bogus, okay? Accrual versus cash accounting. Like I said, we're not going to go into cash basis accounting at all, other than to point out that it does exist. However, if you have a business and you're running it on a cash basis, you'll never be able to borrow money. No auditor will sign off on your financial statements. You'll be an island unto yourself, okay? Accrual-based accounting. Transactions recorded when they occur. The companies recognize revenues and expenses when incurred according to GAAP. You get the idea, Liber, that expenses and revenues are recorded when they occur, not when money is paid. Cash basis, they recognize everything when the cash is paid, and it's not GAAP. Okay, we're not going to worry about comparing accrual versus cash. Now, adjusting journal entries. This is a new area for us. And let me take a snort here. Whoa, is that good? Need for adjusting entries. We must ensure that revenue and expenses are recognized properly. These adjusting entries are necessary, Labra, because the trial balance may not contain up-to-date and complete data. It could be wrong. And they're required every time a company prepares financial statements, and will include one income statement account, one balance sheet account. And that's a good little tip. Every adjusting entry will have one income statement account and one balance sheet account. What we're saying here is at the end of the month, you prepare a trial balance. That trial balance by definition is incomplete for reasons we're going to learn in a few minutes. We have to now adjust that trial balance with a series of journal entries to get it to the point where it's acceptable and become a source for preparing the financial statements. Adjusting entries are made to ensure that expenses are recognized in the period in which they're incurred, and revenues are recorded in the period in which the services are performed. We can't say that enough. Balance sheet and income statement accounts have correct balances at the end of the period. We want that to be another result. And all the responses above are correct. Okay, now we're getting into the different types of adjusting entries. Let's first break them out into what we call deferrals and accruals. A deferral is a situation in which money changed hands, but nobody's done any work yet. Therefore, there is no income or expense reported at the time of the cash movement. So that requires an adjusting journal entry for later. Deferrals, money changed hands, but nobody did anything. Accruals, that's a category of revenues and expenses where we have incurred the revenue. We have to record that revenue. We have incurred the expenses, but we have not recorded them yet, and no money has changed hands. So when we talk about the deferrals, we're talking about two things really: prepaid expenses and unearned revenues. So let's look at this trial balance here. Subsequent examples, this will go through the whole chapter. Here is a trial balance, and they're just showing it to us, and it's probably an unadjusted trial balance for the Sierra Company. I'm not sure if I want to look at this just yet. Yeah, let's look at this here. Below is a list of timing concepts in the left column with the description of the concept on the right. Match the description to the concept. Accrual-based accounting. Companies record transactions when they occur. That's what accrual-based accounting. E, calendar year. We know what that is, January through December. Periodicity, that's where you can divide a business into a particular month. Expense revenue principles. Efforts should be matched with results, revenues. Okay, now they take us back to deferrals. We had a little sidetrack. Remember this series of arrows we have here? This is our cycle. We start on day one of the month by analyzing transactions, and you learned how to record them into the journal. You learned how to post them, and we learned how to prepare a trial balance. Trial balance comes right from your general ledger balances. Now we're going to learn about adjusting journal entries. First kind of deferral entry, prepaid expenses. Payments of expenses that are recorded as an asset to show the service or benefit the company will receive in the future. Let me make that easier to understand. We're talking about something like an insurance policy. On December 31st, 2021, your company bought a one-year insurance policy. Well, obviously that policy covers you for the year 2022. You have no insurance in 2021, we're going to assume. So when you bought that insurance policy, it's not an expense in 2021, it is an asset. It's definitely an asset. An insurance policy is a nice asset to have. But the expenses related to it are not going to be recorded until the year 2022. If your factory burned down on New Year's Eve, 2021, you have no insurance. You're stuck. If it happened the next day, you're fully insured. Okay? So prepaid items are expenses paid in advance. We purchase them in advance. And there's all kinds of different ones. In our book, insurance and supplies are prepaid. You can have prepaid advertising, prepaid rent, and we have depreciation on buildings and equipment, okay? Prepaid, money changed hands, but nobody's done anything yet. So take a peek here. We're going to record the journal entry with a debit to an expense account. We're going to debit the expense and we're going to credit the asset account cash. I don't like this grid here. This is a little more clear. Sierra Corporation purchased supplies costing $2,500, and they did this on October 5th. The account shows a balance of $2,500 in the trial balance, okay? That's what's sitting on the trial balance because that's the only entry we made. We debited supplies for $2,500. That's what's in the trial balance. But at the end of the month, they counted the supplies and only $1,000 worth of supplies are left. That means we consumed or we used $1,500. Now we record the expense. You debit supplies expense for $1,500. You credit supplies for $1,500. And since this can get a little tricky, Liba, you interrupt anytime you have a question or anything, okay? If I'm going too fast. Supplies. And they're giving you a big, long-winded thing here, but this is worth checking out, huh? The supplies expense has increased $1,500 because of this. So our asset supplies went down and our supplies expense, $1,500, went up, or another way to say it is equity went down, okay? Debit increased expense, debit supplies expense, credit decreases assets, credit supplies. There's your journal entry. And here's what it looks like in the general ledger. You had $2,500 in the trial balance at the end of the month. Now you only have $1,000 because you adjusted this out, okay? So that's an example of a deferral, a prepaid expense. Insurance, that's my favorite. This is the one that makes it most clear, I think. They purchased an insurance policy for $600. $50 of it does go into October, but $550 is going to be in the future after October. So how much of this how much of the $600 insurance policy have they consumed? Have they gotten the benefit of? They got the benefit of the 1 month, which is 600 divided by 12, and there you go. You got $50. Debit insurance expense, credit prepaid insurance. And let me give you another tip. Think of adjusting journal entries as a search for unrecorded expenses. That's what they are for the most part, unrecorded expenses and revenues. And they're giving us the same sheet here with the insurance. We debit insurance expense, we credit prepaid insurance, and we take a peek at it in the general ledger. Now the general ledger is correct for both insurance expense and prepaid insurance. Depreciation. We've not talked about depreciation, I don't think. Depreciation is an expense. It's an expense with no cash involved. It's recognition that equipment has wear and tear, that equipment breaks down, that it wears down, has less value as time goes on. Buildings, equipment, motor vehicles are recognized as assets rather than an expense on the day acquired. Well, that makes sense. You buy a company car today, that's clearly an asset. It's not an expense. But we're going to turn that car into an expense, sort of, by a monthly depreciation expense. It's the process of allocating the cost of an asset to expense over its useful life. Keep in mind, depreciation does not attempt to report the actual change in the value of the asset. It's an allocation concept, not valuation. So here we go. Assume that depreciation on equipment is $40 a month. Look at that journal entry. Debit depreciation expense, credit accumulated depreciation. Accumulated depreciation is an account you're seeing for the first time. It's a contra asset expense. Contra asset. It means that it's an asset account, but it has a credit normal balance that makes it an outlier. And you're going to hear more and more about contra accounts as we go on. There's about 4 of them that we'll learn about in this course, okay? And there's a few others beyond that. So this is the journal entry you pray they put on the exam, because it's the easiest, I think. It's always debit depreciation expense, credit accumulated depreciation. Excuse me, just a few seconds, please. I had to grab a few tissues. Depreciation expense. And here's our journal entry. You debit depreciation expense and you credit accumulated depreciation. And they're showing you the journal entry. Accumulated depreciation, let's talk about that a little more. It's a contra asset account with a normal credit balance. It offsets the original cost of the asset. The difference between the accumulated depreciation and the original cost is called the net book value. You see that $5,000 there, equipment, Liba? That is never going to change. You bought an asset for $5,000. That $5,000 is never going to be reduced, okay, unless you sell the asset. But here we're saying we have $5,000. Less the accumulated depreciation gives you $4,960. So every month, the accumulated depreciation is going to go up $40 and thus reduce the net book value. And the equipment will remain at $5,000. And here's some examples of the prepaid expenses we just did. Okay. Unearned revenue. This is the final one of our deferred entries, okay? Unearned revenue. Again, it's a deferral, meaning that money changed hands and nobody did anything. The service was deferred. Unearned revenue is in a situation where we receive cash in advance for something, okay? For example, rent. Somebody paid 3 months rent in advance and we're the landlord. Well, our company cannot record those rent payments as expense until the tenant actually uses the apartment, okay? So we receive 3 months rent in advance for, say, $6,000. We're going to debit cash, right? We debit cash, and we are going to credit an account called unearned revenues, which is a liability account, believe it or not. How could we get money in the mail and suddenly we have a liability? Well, we have a liability in rent. The liability is not cash. The liability is we owe them rent. I'm a big sports fan, Liba. I buy Dodger season tickets for, say, $24,000. I buy my tickets in February, but they don't play baseball until the 6 months beginning April. So when the Dodgers get my money, they debit cash, they credit unearned revenue, and then after they play a month's worth of baseball, then they debit the unearned revenue liability account to reduce it and record ticket revenue. That's when you record the revenue. Unearned revenue. Sierra received $1,200 on October 2nd from Knox for advertising expenses to be completed by the 31st, okay? So unearned revenues shows a balance of $1,200 at the end of October. But then you realize at the end of October, they did use 1/3 of this advertising. They perhaps did put an, excuse me, did put an ad in the newspaper for $400. So now we debit the liability unearned revenue and we credit service revenue. And again, they're taking us through this lengthy look here. But let's pay extra attention to the unearned revenue because that one can be a little tricky to understand. What has happened here? We received money in advance for rent, $1,200. At the end of the month, the tenant spent 1 month in the apartment or whatever it was. So we're going to now debit the liability unearned revenue and credit service revenue. And our trial balance is adjusted properly for that. And they're showing you accounting for unearned revenues. The ledger includes these. Prepare the adjusting entries for the month of March. Well, this is an assignment they just gave us, okay? Let me just see one thing here. Good. Well, let's work on these together, Lab. You ready? We have adjusting journal entries. They're telling us already it's just going to be the deferrals. So we know that there was no cash involved, that money changed, that was cash involved, money changed hands, but the work's not been done. Insurance expired at the rate of $100 per month. There looks like there's $3,500 sitting there, right? Well, we have to reduce that by $100. And there's our journal entry. We debit insurance expense and we credit prepaid insurance. The next one, supplies on hand total $800. Well, there were $2,800 of supplies that we purchased that we haven't put into an expense yet. So at the end of the month, they had $800 on hand. That means that they consumed $2,000. Debit supplies expense, credit supplies the asset. Remember what we said? Every journal entry is going to include an income statement item and a balance sheet item. The equipment depreciated $200 a month. This one's pretty easy, $200 a month. We know the journal entry is going to be a debit to depreciation expense and a credit to accumulated depreciation. And then the last one, during March, services were performed for $4,000 of the unearned revenue. Well, the unearned revenue was $9,200. They're telling us that they performed $4,000. So $4,000 is the revenue recognition. And there it is right there. You debit unearned revenue and you credit regular revenue. Now, we said we had two types of adjusting journal entries. One, deferrals, two, accruals. We're going to go into accruals now. Deferrals, remember, money changed hands. Nobody's earned anything yet. Accruals are the opposite. There's no cash involved at all. No money has changed hands, but we have incurred an expense. An example might be at the end of the month, your trial balance shows $0 for electricity expense. Did you use electricity during the month? Of course you did. So you're going to have to come up with a number to record the expense. That's called an accrual. You're going to debit electricity expense for, say, $1,000, and you're going to credit accrued payables for $1,000. That's the type of thing we're doing with accruals. And you could also have accrued revenues on a borrowing situation. So let's see what we have here. We're up to the blue again. We're journalizing and posting journal entries. Accrued revenues. Accrued revenues. What we're talking here, Liba, is interest that's due, okay? Accrued revenue. We loaned money to somebody, all right? We loan money to somebody. And they pay us interest once a year. They just pay it at the beginning of the new year for the prior year. We have to accrue that revenue. That's money that belongs to us. So we are going to debit interest receivable and credit and credit interest income or interest revenue of some kind. We performed $200 worth of services. We already did the work. They weren't billed. So we have to accrue them. We have to bill them. We have to bill them out here. We debited accounts receivable, credit, service revenue. Then we get paid. That's not really an adjusting entry. That's a basic entry. But when we talk about accruals, let's talk more about expenses because that's where they really come in. You could have accrued rent, accrued salaries, interest like you're showing here, taxes, accrued advertising. You could have accrued any expense. Any expense may need to be accrued. And there are always accruals necessary at month end. Accrued entries, you're going to debit an expense and credit a liability. So think about that for a second. That's what an accrual is. It's the recognition of an expense that has not been recorded and setting up the commensurate liability. It's money we do have to pay in the future. So let me take another belt here. A little strong, but good. Interest, here we go. Here's a good one, interest expense. Sierra Corporation signed the 3-month note. They borrowed money, $5,000. The note is 12% a year. Well, they have to, at the end of the first month, accrue the interest expense. This is money they're going to pay later, Liba, but they have to recognize the expense now. Now, an important thing to point out is whenever you see an interest rate, it means for an entire year. So you've got $5,000 times 12%, which would be $600, but that's for a whole year. So we just divide by 12 to get the monthly interest. And they're going to have to write this journal entry 12 times over the next year. Every month, they're going to debit interest expense, credit interest payable. So you have the interest expense in the proper period, and you have the payable going up, 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 as it properly should, until you get up to $5,000, and then whammo, you make the payment. And you're showing that long thing. Now, here's one, I'm sure you've been out in the workforce, and your husband, and you understand that when you finish the work week, you don't get paid through that day, right, Liba? You get paid maybe in a week or two. You work from the 27th of the month, say, to the 31st. Well, that's money that you earned in that month, but you're not going to get paid for it for another week or maybe two, depending on your company's policy. So we have to, as a company, recognize that you worked from the 27th through the end of the month in October, and that money needs to be accrued in October. So take a look at this calendar. The employees receive total salaries of $2,000 for 5 days or $400 a day, okay? The pay period began on the 15th and it goes through the end of the month, it looks like, okay? So here we go. On the 26th is payday. On the 29th, 30th and 31st you worked, but you're not going to get paid until the 9th of November. So we have to say to ourselves, this expense of $400 a day belongs in October. So we are going to debit supplies expense, not supplies, I'm sorry, I meant to say salaries and wages expense for $1,200, and we're going to credit salaries and wages payable for $1,200. All right. And look at your general ledger. We had $4,000 in expenses. That $4,000, that represents the payday through the 26th. You took care of everybody through the 26th. We have to put the rest of the month here, that $400. And the payable goes up, and that's genuine liability that we owe, okay? And we do owe it. If you quit your job at the end of the month, they'd owe you that $1,200. If the company went out of business, they'd owe you that money that day. Accrued expenses. So here they're just kind of summarizing the four kinds of expenses. We have the deferreds and the accruals. The deferreds are the prepaids and the unearned revenue. And one thing I meant to point out that's not in the book, a prepaid expense and an unearned revenue are the same exact thing. They're the same thing. It depends what side of the transaction you're on. For example, when I bought those Dodger tickets, I debited an account called prepaid tickets that I give out to my customers, okay? And I credited cash. The Dodgers, when they got my money, they debited cash and credited unearned liability. So if you keep that in mind, that a prepaid expense and an unearned revenue are the same thing, that might make it a little more clear right now. And then what do we accrue? We accrue revenues, mostly in the form of interest income if we've loaned money to people, or we have a whole bunch of accrued expenses. Prepare these adjusting journal entries. Computer services began operations on August 1st, 2022. At the end of August 2022, management prepares monthly financials. So, Liber, what we're going to do here, they want us to prepare some journal entries. So let's take a peek at this. Hi, Wendy. Wendy.
Hi. Hello. I'm good. How are you?
Welcome to the class.
Thank you.
Got a whopping 2 people here. It's been me and Liba each class. How you doing with the course, Wendy, so far? You finding it okay?
So far, yeah. So far, it's going good.
Okay. Well, we've obviously been recording up to now, so we'll continue. We're adjusting journal entries, okay?
Okay.
All right. So Micro wants us to prepare these various adjusting entries. They owed the employees $800 in wages at the end of the year. That's an accrual entry. That's where we're going to debit wages and salaries expenses and credit wages payable or salaries payable. They borrowed $30,000 from the local bank on a 15-year mortgage. The annual rate is 10%. And what we were saying earlier, Wendy, when you see a percentage, that means the percentage for a year. So 10% of $30,000 is $3,000. And if we have to break that down into 1 month, we will do it by dividing by 12. Revenue for services performed but unrecorded. Okay, here is your unearned revenue account. We're going to debit the unearned revenue, which is a liability account, and credit regular revenue. And let's just take a peek at the journal entries here. August 31st, the company owed its employees $800. Okay, these are wages that you worked, Wendy, but you haven't been paid for yet. You worked from the 27th of the month to the end of the month. Well, you're not going to get paid until the following month. But to the company, that's expense they have to record in the current month where you worked it. So that's what we're doing here on the adjustment. We're saying Wendy worked $800 this week. We're not going to pay her for a while, but we record the expense and we record the payable. There is the interest rate of $250, 10% times 3,000 divided by 12. And revenue for services performed but unrecorded. That's not really an adjustment. Okay. All right, Wendy. So you popped in here as we finished up with adjusting the journal entries, okay? Now we're at a point where you guys can kind of link up together as we go into the next step. Now we have adjusted the trial balance. As we learned here today, the trial balance, when it is printed out, by definition is wrong. It's incomplete because there are only certain entries that can only be done at the end of the month. And they're called these internal type entries, okay? So now we're working our way through these red arrows. We're up to the adjusted trial balance, all right? So let's see what we got ourselves here. Here is our trial balance, okay? And what they're saying is the red numbers, you recognize those red numbers, Liba? Those are the ones that we adjusted, okay? Those are the ones that we adjusted. So now we have a perfect trial balance. We can go, we got the hard part done. We did the adjusting journal entries. And that is the hard part of any closing. So now we've got that done. We are ready to prepare the financial statements. Which of the following statements is incorrect concerning the adjusted trial balance? The adjusted trial balance lists the account balances segregated. Yeah, boy, that's questions of dog. Okay, now we're ready to prepare our financial statements, huh? Financial statements. They are prepared directly from the adjusted trial balance. That's how important that trial balance is. And the financial statements have to be done in a certain order: income statement, retained earnings, balance sheet, okay? Income statement goes first. So take a peek at what we have here. Here is our trial balance. Here is our trial balance. And as you can see, they're pulling the number directly from the trial balance. And let me give you a hint. You see where it says revenue, everybody? Revenue? If you drew a horizontal line above that, see that 10,600? Imagine putting a line above that. What you've done is remind yourself that everything below that line is your income statement and everything above it is the balance sheet. So that might be a little tip to keep in mind to keep you from being confused a little bit. So here's our trial balance. And let's see, we had 10,600 in income, revenue. We had these various expenses. Some of them we accrued, some of them we did not. Some of them did not require adjustments. They total 7,740. They leave us with net income of 2,860. There's your income statement. So that's not too hard, huh? The income statement. The income statement are your sales minus your expenses. The reason we do the income statement first is we have to get the net income to do the retained earnings statement. So let's take a peek at the retained earnings statement, huh? This is pretty easy, the retained earnings statement. It is your beginning retained earnings. And they're saying that it's zero because this was a new company. Sierra had not been in business. This is their first year of business. So beginning was zero. Add the net income of 2,860 and subtract any dividends. And you can pull the dividends right off of the trial balance. So the retained earnings at the end of the month, 2,360. 2,360. Let me reduce this down here. 2,360. Okay. Now that we have that 2,360, we can do the balance sheet. And look how easy the balance sheet is. All you're doing is copying everything from the trial balance except one thing, and that is the retained earnings number. We bring the retained earnings number over to 2360. You typically don't show the dividends on a balance sheet, although I've seen companies that have done that. But your statement of your equity statement, your retained earnings statement, gave you this number here, the 2360. Everything else was copied from the balance sheet. Okay. Following okay, Liba, so far?
Yes.
Okay. Skolnick. Do it. Do it, it says. Skolnick. I like that name. Was organized. The company prepares quarterly financials. Here's the trial balance, huh? This is the adjusted trial balance. I have a feeling they're going to ask us to do the financial statements. So how would we do them? Well, let's see. We would go to the Bob Smagula line and find the revenue, and we draw a line right above the 14.2. Everything above that is balance sheet. Everything below is income statement. I noticed they don't have any expenses, though. That's a good company to have, huh? Determine the net income. Oh, I see what they did. Okay. Forgive me. They do have the expenses here. They just presented them. They presented them in a clunky manner. Okay. So let's take a peek at it. Our revenue was 14,200. Now it's a matter of finding all the expenses. And the expenses are right here. 9,400 for salaries all the way through interest. Net income, 2,490. Not too tough, huh? The income statement. The retained earnings statement. Let's see what we have here. Well, they had 0 in retained earnings. 0. So we have retained earnings plus, oh, they want us to come up with the total. I don't know where this came from, out of nowhere. Determine the amount of retained earnings at June 30th, rather. You have 0 retained earnings. You had income of 2,490, which you just did here. So all you're doing is pulling this number over, and you have retained earnings of 1,890 after you subtract the dividends. Now that we have the 1,890, it's rather easy to do the balance sheet. In fact, it's so easy they're not asking us to do it. Okay, so let's just continue now. We got one more piece in this chapter, and this is a busy little chapter. Closing entries. Now, we've gone through our whole cycle here. We analyzed things during the month. We journalized them. We posted them to the trial balance. We just learned how to adjust the trial balance. We got the adjusted trial balance, and we learned how to put the financials together. Now there's one last thing. We have to take that net income and move it up to equity, up to capital, to retained earnings, okay? And that's done via what are called closing entries. You have 2 types of accounts, temporary and permanent. Temporary accounts are closed every month. Permanent accounts are not. So let me give you this the easy way. The balance sheet are permanent. Balance sheet accounts are permanent. You never close cash or accounts receivable or accounts payable. What are temporary are the accounts in your income statement, okay? We have to close those guys down. So here's how we do it. Closing entries recognize in the ledger the transfer of the net income to retained earnings, owner's drawing to retained earnings if we had it, and the dividends to retained earnings. Where it says owner's drawings, they probably wanted to make that dividends. That's a little publisher's error. And what we're going to end up doing is we're going to zero out these expenses and revenues. We're actually going to zero them out. And they're going to be generally journalized and posted only at the end of the annual accounting period. Excuse me. So let's see what we have here. We're going to take our revenue accounts, which have a normal credit balance, and we're going to debit them to make them zero. And when we debit all those revenue accounts, we're going to credit an account called income summary, which you're seeing for the first time. We also have to zero out the expense accounts, which have a debit balance. So we're going to credit all the expenses. Now we have zero expenses because we move them from expense into income summary. At that point, the income summary equals what? Our net income, right? Because we brought the revenue and expenses in. Now we simply zero out the income summary into retained earnings. Dividends, we automatically bring over directly to retained earnings. So take a look at the journal entry. This might make it a little more clear. We had one kind of revenue, service revenue. We debit it for $10,600. Now we have no more revenue. We credit income summary. The second entry, we know we're going to debit income summary because we're crediting each of the expenses one by one, okay? And that gives us an income summary number of 7740. So we have 10,600 sitting there in revenue, 7,740 sitting there in expenses. In other words, that's our net income is now in income summary. And here's the journal entry. You debit income summary for the, let me say this correctly. They're skipping ahead. I thought they were going to show the entries differently. But what we've done now is we've got the income summary account including the income. So the income of 2860 has to come out of the income summary and moved over to retained earnings. That's where your income goes. That's why it's called retained earnings. And then we also have to close the dividends. We don't want to show the dividends on our financial statements, so we just close them into income summary. And at that point, we're done. We are done. Let's just take a peek at what it looks like here. Look at your general ledger. Income was 1,500 expenses. We credit it for 1,500. Depreciation expense, we credit. And we end up debiting 7740 for the total expenses. We credit service revenue. We credit service revenue for 10.6 and we move it over. There's your balance there. Oh, hold on. I screwed this up. And there is your retained earnings. Now has gone from 0 to 2360. Summary of the closing cycle, huh? Wow, you're getting sick of seeing this, huh? The accounting cycle. Analyze transactions, you journalize them. You learn how to do that. You learn how to post them to the general ledger, prepare a trial balance, journalize and post your adjusting entries. And that's where you came in, Wendy, as we were finishing up this part here. And then you prepare an adjusted trial balance, prepare the financial statements, journalize and post those closing entries, and prepare your post-closing trial balance. The post-closing trial balance, by definition, will only have the permanent accounts. There will be no revenues and expenses there. Do it. Hancock has the following balances in various accounts. Okay. So they're showing, they want us to do the closing entries. What do we close? We close the temporary accounts, which are revenues and expenses. You close revenues and expenses. So let's see what we have here. Accounts payable, we don't close that, of course. We have revenue, we're going to close that. Expense, we're going to close that. Dividends, we want to get rid of that. Retained earnings, we need that. And we're not going to touch accounts receivable. Receivable, that's an asset, permanent. and we supplies expense. So we have one revenue. We debit the revenue, credit income summary. We have expenses, we have rent, salaries, and supplies, it looks like. Rent, salaries, and supplies. Rent, salaries, supplies. We credit them and we debit $80,000. So we have net income of $18,000. We have 98 in revenue, 80 in expenses. We're now going to take that balance of 18,000 and move it into retained earnings. So the income summary is 0, and we get rid of the dividends into retained earnings, okay? Describe the purpose and basic form of a worksheet. Let's see if we want to look at this. Multi-column. This is how, this is Appendix A. I'm going to go through this briefly. Most textbooks really go into this in more detail than this book. Here's how you keep track of the adjusting entries. You have this worksheet. You have a worksheet where you list all the accounts, and the first 2 columns are the trial balance. The next 2 are the adjustments. And then you take the trial balance, beginning trial balance, plus minus the adjustments. You get the final adjusted trial balance. And from that, you can do the income statement and the balance sheet. And they're just showing you here. I'll just show you a couple. Look at supplies. Well, remember they said we had 1,000 in supplies at the end of the month? That means we have to debit supplies expense for 1,500 and credit supplies for 1,500. So supplies go from 2,500 down to 1,000, and supplies expense goes up from 0 to, in this case, to 1,500. Let's look at the accrual for the salaries, okay? Salaries. We had those hours that you worked at the end of the month. So we're going to debit salaries and wages expense 1,200. They had already recorded 4,000 in salaries for the prior weeks. So that gives you a new balance of 5,200. And here is our credit to accrued salaries and wages payable, okay? Other textbooks make you do this worksheet quite a lot. It doesn't look like that's the case here. And when we get to IFRS, that means I quit. I don't go into that, nor do the other teachers really. We do ask you to just glance at it and get a feel for the different changes, but there's really not much to it, usually just a couple of pages. Okay. Okay, Liba, any questions, any comments?
No, I just get like confused about what to put in the debit and what to put in the credit.
That's still, there you go. Okay, so you're still fighting with the debits and credits, huh?
Yeah, I guess I just need to like memorize.
Yep. You know, I gave you that thing about after eating dinner, let's read comics, maybe that helps. But yeah,
Yes.
until you get comfortable with the debits and credits, you'll be fighting a little bit. But but you're doing good. I mean, I can tell you're picking it up. But yeah, master those debits and credits. It makes life so much easier for you.
I'll put in the time this weekend to memorize it.
Great. And also, you're not the only one having trouble with debits and credits, right, Wendy?
Right.
Yeah. If I said, Wendy, I got a question for you. You ready?
Yeah, ready.
Accounts payable, debit or credit balance? You got to get to the point. I'm teasing you just a little bit. Like Family Feud. Yeah. You got to get to the point where there's absolutely no hesitation. That's what we're saying here. Okay. So yeah, you have to understand those debits and credits. All right. Do you mind if I tell you a bad joke I tell all my students every year about this? About a guy worked in accounting for 50 years, right? And every year he came to work and he opened up a drawer in his desk with a key and he pulled out a piece of paper the size of a little Post-it note and he looked at it for a few seconds and he shook his head. After he retired for 50 years, they wanted to see what was on that note. So they got the key and they opened it up. You know what he wrote on that note? Debits on the left, credits on the right. The point is you shouldn't take 50 years to figure out the debits and credits, okay?
I got it.
Did you have any questions, Wendy? You know, you keeping up on the homework?
Yeah, I actually I'm all complete with the homework this week.
Were you in my 110 class at all?
Yeah.
Oh, okay. So all right. So you know my style a little bit, huh?
Yeah.
Okay. All right. Well, if they have no more questions, I'll let you go. Okay.
Okay. All right.
All right. You guys have a good weekend, and we'll be back in the saddle on Tuesday morning at 8:30. Okay.
Okay. Sounds good. Thank you.
All right. Tell your friends.
Bye.
Bye bye.
Bye.
See you on Tuesday.